$7,200. That's the average size of the hole. Not a medical bill, not a credit card. It's the gap between what millions of Americans owe on their car and what that car is actually worth. It's called negative equity, being underwater. And right now, nearly 1 in 3 people trading in a car owes more than the car is worth. The highest share in almost 5 years. In the next few minutes, you'll see exactly how that hole gets dug, why your brain is built to look away from it, and the 3 moves that get you out. Because here's the uncomfortable part. Negative equity isn't a math accident. It's a system, resting on one of the oldest circuits in your head. The industry doesn't need you to be bad at math. It just needs your brain to do what it has always done with a loss: refuse to look. So, one plain sentence first. Negative equity means the loan on your car is bigger than the value of your car. If your payoff is $36,000 and the car would sell today for $31,000, you are $5,000 below the line. The car was never the asset. The loan is the anchor. And the scale is anything but small. At the end of 2025, 29.3% of trade-ins toward a new car were underwater. The average gap? $7,214, an all-time record. And of those underwater trades, 27% were carrying a hole of $10,000 or more, also a record. This is not a fringe mistake. This is the middle of the market. And the payments tell the same story from the other side. A record share of Americans are now signing car payments above $1,000 a month. The average underwater trade-in is a car bought just 3 or 4 years ago, right in the middle of the pandemic price frenzy. These are not reckless buyers. They are ordinary people whose timing was expensive. Now the mechanism. Because on this channel, the number always has a neuron attached. Your brain runs on a rule that Daniel Kahneman and Amos Tversky measured decades ago. A loss hurts roughly twice as much as an equal gain feels good. It's called loss aversion, and it sits deep. The amygdala, your alarm system, fires harder for losing than for winning. And for most of human history, that setting was correct. For your ancestors, losing stored food before winter wasn't a bad quarter. It was a survival event. So the brain wrote a simple policy. A loss only becomes real on the day you admit it. Until then, it's just a number you avoid looking at. Economists call the result the disposition effect. We refuse to close a losing position. And an underwater car loan is exactly that, an open losing position, parked in your driveway. So let's dig the hole in slow motion with real numbers. The average new car in America now sells for around $49,000. Add taxes, fees, maybe an add-on or two, put little or nothing down, and you're financing roughly $50,000. And here's the detail almost nobody prices in. The hole opens on day 1. The moment the car leaves the lot, it becomes a used car, worth thousands less within weeks. But the taxes and fees you rolled into the loan? The market gives you 0 credit for those. With nothing down, you can be underwater before your first payment is even due. Run that as a modeled example. $50,000, 9% interest, 84 months. The 7-year loan that has quietly become normal. The payment lands near $800 a month. Feels manageable. That feeling is the product. And 9% isn't pessimism, by the way. It's a modeled middle for this rate era. New car loans have averaged around 7. Used car loans around 11. Because now 2 curves start racing, and they are not close. The car sheds value fast, around 20% in the first year, roughly 30% by the end of year 2. Your loan balance, meanwhile, barely moves. Because in the early years of a long loan, most of each payment is interest. 2 years in our modeled estimate, you owe about $38,700, on a car worth about $34,500. You did nothing wrong. You made every payment, on time for 2 straight years, and you are more than $4,000 below the no line. And if you bought during the frenzy of 2022 or 23, when cars routinely sold above sticker price, your curve started even further apart. Those loans are aging into a normal market now. That's why the record is being set today, by people who simply bought a car when everyone else did. Which brings us to year 3, and the moment the whole industry is built around. You walk into a dealership wanting something new, and you hear the most soothing sentence in retail. Don't worry, we'll pay off your old loan. And they do pay it off. Then they quietly add your $7,000 hole to the price of the next car. This is the rollover. In the real data, buyers who roll negative equity finance about $11,500 more than everyone else. And their average payment is $916 a month, against an industry average of $772. Run our modeled loan again with the whole rolled in. $57,000 financed over 84 months, and the math lands at about $920 a month. Almost exactly what the market data shows. The model and the reality agree. Now notice what your brain did in that showroom. It never priced the $11,000. It priced the monthly. Psychologists call it mental accounting, narrow bracketing. The mind evaluates the payment, not the position. $140 extra a month feels like a rounding error. $11,000 of debt never gets felt at all. And there's a second circuit, working that room with you. The new car is right there. You can smell it, touch it, drive it home tonight. The debt is abstract, distant, sliced into 84 identical months. Neuroscientists call the tilt temporal discounting. The dopamine system prices now at a premium and marks down everything later. The showroom isn't fighting your willpower, it's selling straight to your wiring. And so the treadmill turns. 40% of buyers who roll negative equity stretch the next loan to 84 months. Longer loans mean slower principal, which means more years spent below the line. Which means the next trade-in starts even deeper than the last one. And the treadmill has walls. Lenders cap how much total debt they'll attach to a given car, so a deep enough hole can literally lock you out of cheaper vehicles. People try to downsize their way out of the problem, and discover the debt won't fit inside a smaller car. The responsible move gets blocked by the math of the earlier one. Which raises the real question. If the math is this predictable, if the industry can see the hole forming years in advance, where's the proof that they know? Here it is. There's a product called GAP insurance, Guaranteed Asset Protection. It exists for exactly one scenario. Your car gets totaled, the insurer pays what the car was worth on the market, and you keep making payments on the part that no longer exists. Think about what that means. An entire insurance category, sold at scale, invented because so many drivers owe more than the car is worth. GAP is not a scam. If you're underwater, you genuinely need it. But its very existence is the confession. The system prices your blind spot and then sells you protection from it. So, what do you actually do? 3 moves. Simple, not easy. Move 1. Find your number today. Call your lender and ask for the payoff amount. Look up what your car actually sells for. Subtract. 10 minutes, 1 number, your equity, positive or negative. Most people underwater have never done this once because the amygdala files it under later. Doing it anyway is the whole move. Practical detail. The payoff quote is usually valid for about 10 days, and an instant online offer gives you the car's real market number, not the number you hope for. Move 2. If you're below the line, stop trading. Drive through it. Depreciation slows sharply after the early years, while your principal finally starts to move. The two curves cross, and time starts working for you instead of against you. Round the payment up and send the extra straight to principal. And dig out your original contract, unused add-ons, extended warranties, service plans, tire packages can often be canceled for a prorated refund that shrinks the payoff directly. Move 3 is for the next car, and it's a single rule. Never finance the whole. Cover the first year of depreciation up front, that's roughly 20% down, or keep the loan at 60 months or less. Do one. Ideally, do both. And if a stretch underwater is truly unavoidable, carry gap until the day you cross back over the line. And none of this makes you foolish. Loss aversion isn't a defect, it's standard human equipment, installed long before car loans existed. The market simply learned to bill it. But what the market can bill, you can budget against. So here is the whole story in one breath. The loss happens the day you drive off the lot. That part was never optional. The only question your brain gets to answer is whether you face it once, now, or finance it at 9%, again and again. Tell me in the comments, above the line or below, and by how much. No judgment here. The number you're willing to admit is the only number you can fix. And if this is the kind of math nobody showed you before, subscribe. Then go watch the $489 trap episode, because a payment that feels fine is exactly how they reel you in.